Think back to early 2020. The world basically slams on the brakes, right? And the global economy just veers off into completely uncharted territory. You've got governments throwing trillions of dollars at the problem, creating all these new rules, and all the while the stock market is on one of the most chaotic roller coaster rides in history. The big question was, what was actually causing what? And that really is the question, isn't it? It's what everyone from Wall Street to your kitchen table was trying to figure out. Did all those lockdowns and stimulus checks and health mandates actually calm the markets down? Or did they just pour gasoline on the fire? Well, let's get into it, because a team of researchers found a really fascinating way to finally get some answers. First, we really have to get our heads around just how massive this puzzle was. This wasn't just one market we're talking about. It was a global tangle of government actions and market reactions. So, on one side, you have these huge, sweeping government interventions. Lockdowns, travel bans, income support, you name it. And on the other side, you've got markets just swinging wildly. Sometimes they'd crash, and other times they'd rally on the very same piece of news. The line between cause and effect was just a total blur. And this really gets to the core of the problem. Every government action was like a double-edged sword. On one hand, it sent a message to investors that, hey, we've got a plan, which you'd think would boost confidence. But at the exact same time, every single new rule introduced a whole new layer of uncertainty, fueling these massive, unpredictable swings. So what was the final score? Was it a net positive, a net negative, or just messy? So to untangle this absolute mess, researchers knew they needed a different kind of tool, something that could spot the patterns that our human brains we just can't see them. So they zoomed in on the Chinese stock market, and they pulled daily data from the very start of the pandemic all the way through September 2021. Their secret weapon? It wasn't just any old algorithm. It was a special kind of machine learning that's actually designed to give you clarity. Now, this is super important. First, they didn't just look at government rules as one big blob. They broke it all down into 5 really specific categories. They asked, was it the strictness of the lockdowns, the amount of financial support being handed out, or was it about the risk of reopening things too soon? Each of these could have a totally different impact on the market. And this is the tool they used. It's brilliant. See, instead of a typical black box AI that just kind of spits out an answer without any explanation, they used an explainable model. The best analogy is a flight recorder for the economy. It doesn't just tell you the plane crashed. It tells you exactly what went wrong and in what order. It showed them not just what was happening, but why. So they fed all this data into their economic flight recorder. What did it reveal? Well, the very first major finding was something nobody really saw coming. The AI found that, government policies were okay at predicting which way stock prices would go, up or down. But where the AI really lit up, where it was incredibly accurate, was in predicting volatility. In other words, those wild, stomach-churning, unpredictable swings. Let me just say that again, because this is the key takeaway. The biggest, most predictable effect of all those government rules wasn't on profits or losses, it was on stability. The policies were a much, much better crystal ball for forecasting market chaos than they were for forecasting market cash. But it gets even crazier. The AI didn't just give them one simple answer. It uncovered this incredibly complex web of connections that changed, sometimes dramatically, from one industry to the next. The researchers used these words, heterogeneous and asymmetrical. Now, that's just a fancy academic way of saying that a single government policy could be a massive deal for one sector of the economy and mean almost nothing to another. It could even help one industry while hurting another. Okay, check this out. That government response index, the one that measures overall government action, it was a huge, powerful predictor for stock returns in the materials sector, things like construction, manufacturing. But for the healthcare sector, its predictive power was tiny, almost insignificant in comparison. The same policy, 2 totally different results. And here's another perfect example, this time for volatility. The Economic Support Index, so stimulus checks, debt relief, that sort of thing, it was a major driver of instability in the IT sector. But for consumer discretionary, we're talking restaurants, travel, its effect was way, way smaller. It just proves there was absolutely no one-size-fits-all answer here. Okay, so an AI decoded this incredibly complicated economic moment. That's cool, but what do we actually do with that information? Well, the takeaways here are huge, both for the people making the rules and for all of us trying to navigate the markets. For policymakers, the lesson is crystal clear. These broad, sweeping policies are like using a sledgehammer when you need a scalpel. An action that's designed to help one part of the economy could be accidentally creating total chaos somewhere else. Any future interventions have got to be targeted, surgical, and really aware of these hidden knock-on effects. And if you're an investor, this is basically a new playbook. It proves that government policy is a fundamental force in the market, but in a really complex way. Knowing that, say, the tech sector might go haywire from economic support, while the utility sector barely budges, well, that's critical information for building a portfolio that can actually weather a storm. It's about looking past the headlines to the specific rule and the specific industry it's going to affect. Ultimately, what this research gives us is a powerful new lens. It proves we can actually use AI to see the hidden wiring of our economy, especially when everything is in chaos. So the question it leaves us with is a really big one. Now that we can see the ripples a policy creates before it turns into a tidal wave, how are we going to use that foresight to build a more stable future?